All right, this is exercise 17-10, deferred tax assets and valuation allowance. And we've got a company here that offers a 3-year warranty on all of its products. In year one, the company reported income before the warranty expense of $600,000 and estimated that the warranty repairs would cost the company $115,000 over the 3-year period. Actual repairs for this current year, year one, amounted to $40,000, and the tax rate is 40%. And so what we need to do now is make the journal entries to record the tax provision, and then we'll talk about the valuation allowance in just a second. So we start off with GAAP and tax. And so our first thing that we want to look at is the income before the warranty expense. And in both cases, it's $600,000. Then we have the estimated warranty liability. And that's $115,000. And remember, we can't make any estimates for warranty liability for tax, and so that's zero. We then have the actual warranty costs. And for GAAP, remember the actual warranty costs, the expenses recorded under the estimated warranty liability, and then we take that out of there, that liability, when we actually do the repair. So we have zero that shows up on the, for tax purposes for book, tax expenses for book. But we had $40,000 for tax purposes. And that gives us our income. And so our income is going to be $485,000 for book purposes. And it is $560,000 for tax purposes. Okay, so this is our income. We multiply that times the tax rate. In both cases, it's 40%. And we end up with $194,000 for book purposes. And we end up with $224,000 for tax purposes. And the difference between those two is obviously $30,000. And so now we need to make our journal entry to record that. So our journal entry is going to be tax expense, $194,000. We will have deferred tax asset, of $30,000, and taxes payable of $224,000. All right, now in this case, the company, after reviewing all available evidence, determines that only 75% of that deferred tax asset will ultimately result in taxable expenses on that. And so 25% will not. So we take the 30,000 times 0.25. That gives us 7,500 that we are not going to actually use of that deferred tax asset. So the journal entry we make to record that will be tax expense. This will be an adjusting entry at the end of the year, 7,500, and valuation allowance for deferred tax asset. $7,500. And that concludes exercise 17-10.